Pitch to investors long enough and one of them will interrupt you with, "How much skin do you have in the game?" It's one of the most common questions in fundraising and one that is the most loaded. Answer it wrong and you lose your power position in the room. Lose your power position and you lose the round. No AI will warn you because no AI has ever been asked to invest in their own company. I'm Tony Materna, 32 years pitching investors. I've been asked this dozens of times. If your answer isn't strong, you lose face and self-respect. Here's how to handle it. This is a pitch deck pro tip. When an investor asks about skin in the game, they want to know how much of your own money you've put in your startup. Some genuinely care. Some are just trying to sound sophisticated. Either way, they're working against their own best interest. Here's why. Business case studies show again and again that the more of their own money a founder has personally invested, the less likely the company is to reach its full potential. The founder becomes risk-averse in direct proportion to their own capital at stake. They hesitate to make the big, bold moves that win markets. They cut their price to close every deal instead of pricing for the one customer who would happily pay triple. They chase 10 safe $50,000 contracts instead of spending 6 months chasing the one enterprise deal that would put them on the map. They keep selling the product themselves for 2 years instead of hiring the expensive sales VP who'd outpace them in 6 months. The company quietly becomes a lifestyle business that pays the founder a comfortable 6-figure salary and never dominates anything. It's logical behavior. They can't afford to lose what they put in, but it's terrible for everyone else on the cap table. Here's another pro tip. Startup investors, by definition, lose their money on 9 out of 10 deals. They make it all back, plus a fortune on the one company that returns 20, 30, or 50 times on their original investment. That's the math. The entire asset class is built on, but it only works if the CEO is swinging for the fences. Ask the founder to take the same personal risk a diversified investor takes across 10 companies, and you've just guaranteed the company will play it safe. The one outlier you need in your portfolio won't be this one. It's foolish from every angle. The other reason investors ask is they think the answer measures commitment, as if working 6 or 12 months without pay to get the company to this point isn't commitment enough. Then on top of that, the founder should take personal capital risks. That's an unsophisticated investor. They should stick to real estate, bonds, and the stock market. Here's how I answer. I tell them I have very little or none of my own money in the company. My job as an entrepreneur is to create attractive investment opportunities for early-stage investors. Their job is to fund the ones that match their appetite for risk versus reward. If I have to do both jobs, what do I need an investor for? Then I let the silence sit. The smart ones nod. The unsophisticated ones get uncomfortable. Either way, I just learned which one I'm dealing with. One more thing. If an investor asks you this question, you probably don't want them in your company. They likely aren't going to invest anyway. The problem takes care of itself. Move on. Find investors who actually know how the startup game is played. There are plenty of them. You just have to keep looking until you find the right ones. No AI will tell you this because no AI has ever had to deal with an ignorant investor. For more pro tips like this, see me at pitchdeckteardown.com.